Are you new to investing? Wondering whether or not you can self-manage your properties? Let us tell you about RentRedi. RentRedi is a really awesome property management software that can help you grow and handle every aspect of your real estate business. Rent collection, tenant screening, maintenance, lease signing, listing. Honestly, it has everything.
Yeah, how long do you think we've been using RentRedi for ourselves?
About 5 months.
Yeah, about 5 months. It's been awesome. We do use their push notification system to send notifications to tenants. We collect rent from our tenants right through the app. And we're actually about to use their new feature, their 24/7 maintenance software called Latchel. And a Latchel will allow you to remove yourself as the landlord, as the middleman between your tenants and maintenance calls. So the tenants can directly call a maintenance line, and they will dispatch contractors right to the property.
We should also mention that RentRedi is unlimited. All their plans are flat price. This essentially means you can keep adding properties to your portfolio without having to pay more. You can close on all the properties you want, and RentRedi's price stays the same. The best part is RentRedi's given us an amazing deal to pass on to our weekly Juice listeners. You guys, everyone listening, can get 50% off a RentRedi plan at rentredi.com when you use our code JuicePod. That's RentRedi.com with code JuicePod. JUICEPOD at rentredi.com, and you can get 50% off any plan. If this is your first time here, welcome. During our shows, we interview successful entrepreneurs and investors to spread knowledge, advice, and actionable tactics to help others in the pursuit of financial freedom. We discuss successes, failures, systems, motivations, experiences, and key lessons learned along the way in the hopes that these stories help you along your journey. Tune in every Wednesday to get your weekly juice. If you've been here before and like what you've been hearing, please subscribe, share with friends, rate, and leave a review on Apple Podcasts. That goes an extremely long way for us. It's simple. Just click on your podcast app, type in our podcast name, The Weekly Juice, click on the reviews, and let us know what you think. The more ratings we get, the more eyes we'll get on our show, and in turn, we'll be able to provide you all with high-quality guests. You can also find us on Instagram at Weekly Juice Pod for daily content and personal finance tips to assist in your journey towards financial freedom. Welcome back to the Weekly Juice. As always, Ryan and Cory here with another episode for you. Today, we have on a very special guest. This is a monumental episode for us. We have reached episode 50, brought in a heavy hitter. Many of you probably know him. He is a real estate agent, investor, author, speaker, teacher, entrepreneur, former police officer, and co-host of the biggest real estate podcast in the world, Bigger Pockets, David Greene.
This one's huge. We were so hyped just recording and getting a chance to get to know this guy and talking to him. I mean, he's just like an absolute rock star and professional speaker. Like the way that he articulates his thoughts and his actions, he's really brilliant. And we were just so thrilled to have him on.
We're so thrilled to have him on. Just sit back, buckle up. It's going to be an amazing episode, and I think you're going to take a lot away from it. This is cool for this episode where he typically talks about his real estate portfolio. We dive into the personal side of David Greene and just to get to know him as a human being, which is, for you and I, it was just amazing. So
yeah. And he also gives actionable tactics too on like what to do. And if you're not ready to run through a brick wall by the time this episode is over, like you got to check your pulse. He brings the heat, and let's do it.
Without further ado, welcome Mr. David Greene. David Greene, the man, the myth, the legend, officially welcome to the Weekly Juice podcast.
Thank you, guys. If I can be introduced that way every time I go somewhere, I would like that a lot more. Mr. David Greene, the man, the myth, the legend, your table is ready. Please follow me.
Yeah. Well, it works here. I can tell you that.
Yeah, it certainly works here. The hoodie and the backwards hat, as we said, laid back show. So we are very excited to have some fun today. So most people know you as the Bigger Pockets podcast co-host. And if you could kind of give us like a background on yourself and how you got into real estate, but more so like on the personal side of things that people might not know about you.
Yeah, that's good stuff. I would say that when I was first, I had no intention of being a real estate investor. I'll say that first, just wasn't even on my radar at all. I got exposed to real estate when I was about 19. The big shot agent in my city he was looking to hire, and he had asked friends of a friend if they knew anyone that would be a good worker. And my name came up. I was working in restaurants at the time, going to school. So he called me and said, hey, this is Tim Road. I'm looking to hire a prospector. Do you want to work with me? And I just said, yes. I didn't know what prospecting meant. I literally had never heard that. It sounded like something a gold miner would do. But I just knew if this guy's asking me, then I want to go work for him. So I started with him, and he had me cold calling people. And this was basically around 2001 or so. So what I was doing was going through lists of pre-foreclosure and notice of defaults and contacting people that were going to lose their house and trying to get them to sell it to him. And he would give them a little bit of cash and help them avoid a bankruptcy. And I got paid, whatever I got paid for doing it. And I hated cold calling. So I wasn't very smart. I didn't have any mentors. I was 19. I got stressed out from work, school, and this job. And so I quit that one. And I should have stuck with it because the guy ended up retiring from all of real estate, would have handed the whole thing to me, but I didn't know. And I just knew I didn't like cold calling, and I wasn't learning the stuff I wanted to learn. So fast forward, I become a police officer. I'm saving money because I know I want to buy a house at some point, but this was now around 2005, 6, where it was just ridiculously hard to get a house. They were just going up in value so quickly. That's when they were throwing away these loans that made no sense. And I just figured, well, I'll just save until I can pay cash for one, I guess. Like I don't know, or maybe build my own house. And then around 2010, 2009, the market crashed. That's when I jumped in. It was really good timing for me. Bought my first property because a buddy of mine was moving away to go to Bible school, and he was going to lose his earnest money deposit. And I just was trying to be a good friend. I was like, hey, I'll buy your house and you can get your deposit. I'll just rent it out. And then, when I have a family someday, I'll live in it. So I bought the house and completely got taken advantage of my tenant. I had no idea what I was doing. He was way better at being a tenant than I was at being a landlord. There's a story where I paid $195 for that house, and it had sold a couple years before at $565. It was like a brand new build. Wow. I paid about a third of what it had sold for. So when they collect your property taxes at closing, they do it based on the $595 or $565 amount. Well, the title company sent me a refund check to the address of the property instead of my home address. And my tenant forged the check, took the money, paid me with my own cash for a couple months, and then just completely stopped paying. And my very first property ended up being an eviction.
That's
wow. So
he literally fleeced you. That's crazy.
Yeah.
Wow. So that's quite the introduction to now having built this portfolio, which I think is kind of where we want to touch next. You didn't even really know that much about real estate investing, clearly, who does when they first start, right?
Yeah.
But how did you take that experience and then turn it into, okay, I'm going to keep doing this and do more of it?
Well, it was terrible. I would have sold the house if I could. I was just stuck with it. It hadn't gone up enough that I could sell it. So I put it back on Craigslist, and I did everything again that I had done the first time. I didn't check anyone's credit. I took an application and was like, oh, this person looks good. I was really busy with my new law enforcement career, so I really wasn't paying any attention to what was going on with the property. And I was showing the house to somebody that had wanted to see it online, and they mentioned that they had a property manager. And I said, oh, what's that? Oh, it's this person that helps you find rentals and then manages it for you. He told me I should come take a look at this property. So here we are. And I said, oh, can I get their phone number? And they said yes. And I called the guy, and he was a terrible property manager. But even with a terrible one, it was a bazillion times easier than what I had been doing. And I'm like, man, I was trying to save, the $100 a month or $150 a month. And I lost thousands and thousands of dollars trying to do that. So once I had a property manager, it was like, this is easy. They just send me the check and I just wait. Next year, the rent will go up. And it did. And then I didn't hate real estate investing as much because I was making $300 a month. Now I'm making $400. And it doesn't take much to realize in 5 years, I'm probably going to be making $900. This is cool. And my mom calls me and says, hey, there's a house down the street from where we live and it's vacant. There's a bunch of kids skating in the pool in the backyard that's empty. Do you want to go take a look? So I did. And I thought, well, it's close to my mom. Maybe I'll just live in this one instead and keep renting the other one out. So I bought that house. And now I had a property management company. So I wasn't as scared about making mistakes. I let them take it over. I had 2 properties. The third year, unfortunately, my grandmother passed away and the family was going to sell the house. And I said, well, let's just get an appraisal and I'll just buy it for whatever it appraises for. So now I have 3 houses, and I guess I'm a real estate investor. I own property. I had no intention of doing it. I just, at that point, identified as a real estate investor. And so now when stuff would hit the market, I'd be looking online and I would be talking to people about real estate. And I just slowly kind of started from there.
How did your brain then switch to like financial independence? Like how that you knew that this was going to be a really good thing for you because you fell into it kind of. You all of a sudden you have 3 and now it's like, when did you say, oh no, this is really going to work? Like I'm really going to build wealth doing this.
I was really afraid at the time of not being able to make the mortgage. In fact, every time I bought a house, it created more anxiety because all I could think of is what happens if I don't have a tenant. So it was actually hard to get momentum going because everything inside me was saying, don't do it. And I was sitting down one day and I was looking at, okay, if all my houses are vacant all at the same time for a whole year, this is how much it's going to cost me. I got to have at least that much money in the bank. Just ridiculous type of thinking. And I noticed that I needed to update the rents that were on, like, I think I just used to track it in my iPhone notes app. I didn't even have a spreadsheet. I didn't know how to use spreadsheets at that time. And I noticed that the rents needed to be updated, that it had originally been like 1,100 and now it was 1,400 or maybe 15. And there was something that clicked that I just thought that's kind of a big increase for only 2 years. How did the rents go up that much? We're not even in a good economy. And then I bought a fourplex shortly after that. And I bought it at $700 for rent on each unit. And immediately it became like $800 or $850 as soon as I bought it. I could bump the rents up. And then next year, every one of them went up by $100. And I realized this exponential, I'm not just going up 100, I'm going up 400 a year. In 5 years, that's $2,000. That's a paycheck that I'm getting as a deputy sheriff just from this. And those two components, that rents go up faster than what I thought, mixed with more doors equals that happening even faster. And my mind switched from, oh man, I got to be ready to pay for a vacancy at any given time, into I need more of these because I can get more of that passive income coming in. And I noticed that, you know, as a police officer, the only way you make more money is you work more overtime. It's a very clear correlation between time and money. There's no confusion there. And I was working a lot of overtime, but I could tell I'm not going to want to do this when I'm 30 or 35 or 40. This is my way out. And that was all that I really needed. Once I saw this is something that can be repeated and replicated and you can keep doing it, I knew this is what I wanted to do.
It's a really cool story because there's this thought here about somebody like you that's like, oh, I'm sure David had it all figured out at the beginning, right? How could he possibly get to where he is unless he went in and had it all figured out? And a lot of people are so scared to even start. Yeah. They have to have the LLC. They got to have all their buttoned up. And look at how far you've come by starting by accident, right? So it's kind of a testament to just doing it, learning, making shifts, and then continuing on, right?
Well, that's what I learned. In fact, I probably wouldn't have done it if it wouldn't have been on accident. And then many things since then, I've also sort of accidentally gotten involved with them. And really, there's a pattern you can recognize. Fear will keep you from taking action. If you can fall into it backwards or get somebody else to introduce you to it, kind of break the ice, almost everything that you get into isn't nearly as scary as what you thought. And you'd asked me a question earlier, like, well, what makes David tick? The real reality of what drives me a lot of the time to go start a new business or start a new venture is as simple as the frustration that I'm feeling from somebody else not doing it well. So I would be referring my friends to real estate agents, and then the friends would come back to me and say, the agent didn't tell me this, or they're not telling me that. They want me to write over asking price. I don't get why I have to. My friend didn't write over asking price. You sent me to a bad agent. And I would go tell the agent and they would tell me why, and it would make sense. And there was no communication between the two of them. And I just got tired of real estate agents that didn't help me when I was investing or didn't help the people that I was referring them to. So I said, screw it. I'll go become an agent. And then, I started a mortgage company recently. That was really just from getting tired of the lender not calling back my clients and saying, well, I can't control what they do, but if I had my own company, I could control what happens. And the systems that I create when it comes to investing, like the long distance stuff, was frustration that California real estate got too expensive. I just couldn't buy real estate here anymore. So I went to another state and did it. And then working 100 hours a week as a cop was really hard. And I knew that as the only way that I could buy property until I figured out the BRRRR method. And that mostly came because I was tired and frustrated from working 100 hours a week. So as odd as it sounds, almost every success I've had has been driven by frustration at not liking how life is currently going. And maybe that frustration was more powerful to me than the fear of what could go wrong.
Very, very cool.
I love the way you put that.
Yeah, it's so well put.
Couldn't have said it better. That's really cool how everything kind of flows into each other. And not to say you're a control freak, but you take a lot of people that are frustrated will just sit back and say, oh, I'm pissed off. And they'll start talking crap about everything that's going wrong in their life. And it's really cool to see that you're a prime example of the guy that's on the opposite side of the field that says, no, I'm just going to run through this brick wall and figure it out on my own. So I love that. And you mentioned the BRRRR strategy, and we wanted to kind of dive into this. You talked about having about 5-6 properties in California, kind of fell into them a little bit, but when you found how did you find the BRRRR method? And then did that help you move out of state as well for investing? I know you're in about 4 different states specifically.
Like 5 states now. I would say the out of state investing came first. So what happened after I bought that fourplex in California is I realized I just want to own a bunch of these. Let me buy all of them. And right around that time, it was 2013, the market took off. It literally happened in one spring. It was houses were everywhere. You could pay whatever you wanted into. They're all going 50 grand over asking. It was too late. Because what happened was in 2010, you had all these people that lost their house to a short sale. 3 years later, they're eligible to buy. And they're coming back into the market with rents that are going up every year. And they're seeing that I can get a fixed rate now. It's not going to be adjustable and it's really low. And there's all these incentives the government's providing to buy houses. I'm jumping back in and they ate up all the inventory. So I spent a year, like what you're saying, just being like sulking and feeling sorry for myself that I couldn't buy property anymore until I was watching Fox Business News. And there was an agent talking about how Arizona real estate was just now starting to come up. And it kind of made sense to me. Like, if you guys live like on the coast, you see that like fashion, the cool slang people are saying, the hit songs, they always come out here first. And then 5 years later, they've made their way into the middle of the country. The Midwest finally catches up, right? Like they're all just now saying things like get jiggy with it and all that. It's taking them a minute to catch up. Well, that's kind of what happened with the market. The same thing happened. So I thought, well, the wave's going. Let me get out in front of it. And I called her like 100 times. She finally answered her phone. I said, I want to buy real estate. I flew out there, met with her. No one told me you're not supposed to buy out of your own state. I didn't know it was risky. It didn't really make sense to me that it would be. I just thought, well, when I buy one here, I need a handyman, I need a lender, I need a property manager. Can you help me find those people? And she said, oh yeah, we have all of them. I started buying out of state. I was still putting down 25% on every property, kind of doing it the old fashioned way. The BRRRR method came up when I just realized that I was running at a dead sprint as far as how much I was working. I was sleeping 3 hours a night, maybe in my car to get up and work another 20-hour shift as a cop. You'd sign up for this overtime 2 weeks ahead of time. You didn't know how you're going to be feeling when it actually came. And I was dragging myself through the days and I knew this isn't going to last. And I finally just had a deal come across my desk that was in such bad shape, you couldn't use a loan to buy it. And so I said, well, if I save up another 10 grand, I could just pay cash for this thing. And then I could get a loan after I fix it up. So I need another 10 grand to buy it. And then another 20 grand after that to fix it up. And I realized I had more money in the bank than what I thought. I had a couple other accounts and I just thought, I could buy it cash right now. So I bought a house cash. I fixed it up. When it was done, I went to my lender and I said, hey, I need to refinance this house so that I can go buy the next one. I didn't know what the BRRRR strategy was. I don't think Brandon had coined that phrase yet, or at least it wasn't being talked about very often. And when I did it, they gave me more money than I had put into the house. And another light bulb moment goes, well, that's pretty cool. I would never have to work overtime if I could do this every time. And that's when I started using the BRRRR.
That's great. Can you talk a little bit about what your portfolio, just give an overview of your portfolio now and maybe some of the areas that you invest, where your multifamily and where your single family is? Just because I think that you don't, as much as we listen to Bigger Pockets, I actually don't know if a lot of our listeners know exactly what your portfolio is looks like.
Most of my portfolio is I've got a lot in California and then I've got quite a bit in the South. So I really just like the Southeast. A big chunk of it in Florida, some in Arkansas, a little bit in Texas, and then Arizona. I've got quite a few properties there. I haven't bought a ton in the last couple of years, and it's not because I don't want to buy. I've just been so busy with building up my real estate team and starting the mortgage company and really developing people. I think the last 3 years I've invested in human beings way more than I have in properties, which that could be for several reasons we can get into if you want. But the reality is once you hit a certain point around like 40, 50 homes, you start seeing diminishing returns on the work you have to put into buying a property. Those first 4, 5, 6 change your life. They give you financial independence. They get you out of being a slave to punching a time clock. And then the next one actually start to build you a cushion to where you've got some equity built up. You can get lines of credit. So when a good deal comes your way, you can jump on it because you're tapped into the equity of what you had. You have more money coming in than you were making when you're working. So you don't feel like you can't let go. And then at a certain point to get another $300 a month to go through all the hassle of signing the paper and finding the deal and going in escrow and falling out. And then managing those 40 properties. I was hiring people to help me manage them. And then those people were just kind of losing interest or burning out, or they weren't doing it well. And I got tired of training people to do it. And I just thought, I don't really think I need a whole bunch more single family homes. Let me go become a business person, focus on generating, really taking active income and making that passive through systems and building teams. And then once I get to that point, I'll kind of get back into the investing world and see where I want to go. And so during that period of time, I flipped quite a few houses and I bought some larger multifamily properties with other investors, but I didn't do any single family investing.
This is crazy. You kind of opened the blinds for us a little bit because we're on our fourth, fifth kind of property now, right? Close to 10, going to get close to 10 units here. And it's like, I can feel the momentum. Like I can feel the chugging, but then I never even thought about the diminishing returns aspect. And it's like, yeah, some of these properties do cash flow more than 300 a month, but one of the ones we're working on now is like 300 or 400. And how often do you come across a home run? And at what point are we going to say, let's become the entrepreneurs and not necessarily continue to buy at the rate that we feel like we want to now. So it's a really cool.
Yeah. Do you think about time again? We talk about that all the time. Is the return worth your time? And could it be best used elsewhere? You talked about a lot of different things between systems and how your businesses parlay into each other and building, I think without even realizing it, you probably did, but you learned how to run a successful business by falling into real estate, building different teams in different areas and coaching people along the way, right? You've mentored a bunch of different people, even talking on the Bigger Pockets podcast, but also I'm thinking about like navigating and playing the chess game with all of your different teams in different areas and different investment strategies. That's absolutely helped you to become where you're at now and starting your own real estate team specifically and the mortgage team, which we'll dive into a little bit later in the episode. But I wanted to touch on, you mentioned a lot of people get stuck here, right? Like 4 to 5 properties and it's life-changing for people that actually take the plunge. Then you start scaling up and you get into the realm of, okay, I'm about at 10. And we keep hearing it. And I heard it's a myth. And then I've heard it's not a myth. When you get to your 10th property as like an individual person, how much harder is it to get a loan? And what steps did you take to scale from 10 to say 15 or 20, navigating through the financial world?
That's a really good question. So before I answer the loan thing, I'll give you guys an analogy on what you're going through right now.
We were waiting for, I can't believe it's been 25 minutes before we got an analogy.
You can tell I'm like starting to like sweat. Right, I'm getting nervous.
I see the bead coming down.
Yes, you know that movie with Jason Statham, Crank? You guys ever see that?
Yeah.
He has to get like an adrenaline shot every 10 minutes or he dies. That's like my analogies, right?
Yeah.
He hasn't said one yet. I'm going to die. Where you're at right now is, and where most people are, is they're sitting on a bicycle and they're not going anywhere. They're afraid to ride the bike. What if I fall? What if it's all natural stuff, but fear consumes you. And then if you're lucky, you get a mentor that kind of holds a seat for you while you're going, or maybe you're on a hill like me and you just accidentally start rolling down this thing and you got to learn how to ride a bike because you got thrown into it. But you're in first gear and you're trying to get momentum going. And first gear is meant to make it easy to get started. You're not going to get with every rotation of the pedal, you're not getting a ton of push, but it's very easy to do it. Okay. And so you guys are at the point where first gear, you're almost hitting the max of how quickly you can pedal. When you get to 10 houses, pedaling faster isn't really a thing. You're just going to go the same speed, working yourself really hard. Your legs are going to get really tired. You're meant to progress through gears. Second gear clicks in, and now one pedal is a little bit harder, but you go further with every rotation. And because you have momentum, it doesn't feel that much harder. If you try to start in second gear, it'd be very hard. You'd be grinding away. But you already got momentum from first gear. It's kind of natural. Go to second and then third and then fourth. What you want to be thinking about as you're progressing through investing, if you start building momentum, is when does this feel like I'm just racing in first gear? This doesn't feel right. Because when you watch the people that are actually riding bikes, you can't really tell the difference between how fast their legs are pushing. Right. It all just looks the same because they've gone through gears. And so that's what you guys should be aware of in your position. At what point does getting another duplex just become diminishing returns? You're just pedaling really fast. And you've got a whole bunch of these things and you're running around doing all this work, but you're not really getting anywhere. And so what I had to do with the loans when I hit, for me, it wasn't even 10. I hit about 7 and I wasn't able to get any more, was I had to switch from residential loans, actually they were still residential loans, but they weren't Fannie Mae, Freddie Mac loans. They were portfolio loans. So I found savings and loan institutions, different banks this was kind of my Arizona phase, where I had to put 30% down. I had a 5-1 arm, but I could get a loan to buy investment property out there. And that was cool. I mean, I didn't really like putting 30% down, but it's better than not buying real estate. And then when I got into Florida, I actually got a relationship with the bank that would let me use commercial loans to buy residential properties, but I had to have a bunch of them all together to do it. So I would go in there and I'd buy 3 or 4 at a time, burr them, and then take out money on a line of credit to pay myself back for the money that I had put in. And now that I had that money back, I could go do another 3, 4, maybe 5 at a time, fix those ones out, refinance those with this line of credit that the bank was giving me at a 75% loan to value. And as long as I was all in for around 75% of what the ARV was, I was getting all my money back on that line of credit. When that line of credit hit about $1 million, I would then have to go take that whole portfolio, refinance it again into a bigger commercial product that was like a nationwide lender. Like the same people you would go to if you wanted to buy a multifamily property would underwrite my portfolio of single family homes as if it was a multifamily property based on the cash flow and the debt service ratio. And then my line of credit was paid off, so I could go back to that bank and I could start up again. And so that's kind of what I did for 3 or 4 iterations until frankly, I got tired of just how much work it was to get refinancing. And that was when I made the decision. I just don't want to keep doing this. They make it so challenging to get your money back out.
First of all, the analogy was incredible. It like literally framed it perfectly for me, because we're not at the point where we're at the end of first gear yet, but I can see it on the horizon. Right? Yeah, I can see it on the horizon. So very cool. I'm wondering if you could, maybe you're talking about somebody in our shoes, right? You know, several steps behind you, but we're started in real estate investing. We know it's our future. How do you define, and I'm sure it's different in every market, but how are you defining what is a good deal for you or for maybe the generic person looking for investing? I realize that California is going to be a different deal than in the Midwest, but maybe if you could frame it on just how you see it.
This is actually one of my favorite things to discuss. I'm glad you brought that up, because we'll often say on our podcast, a good deal is not the same for everyone, but I don't really get time to sort of highlight how to know if it's a good deal, because there is a way to know it. But the first thing you have to do is sort of break down what goes into investing. So what you're trying to do is earn money while reducing headache and time. That's the perfect investment. It's a whole lot of cash and not that much headache or time. Money comes in 2 different ways. It can come from cash flow and it can come from equity. Equity comes in 2 different ways. It could come from forced equity or it could come from appreciation. So sort of understanding the relationship of how all that stuff works is the first thing you have to do. You have to know what you're getting. It's just like if you're a professional sports franchise and you're going to go get a good player. Well, the better the player, the higher the salary that they're going to have to pay. That takes up a big proportion of your salary cap. And it might not be best for you to go after the best player that's there, because then you don't have any money left over to put support pieces around him. Kind of have to understand how they all fit together. For somebody who is in a position where they are not making good income, they don't have a ton of opportunity to make more money at their job, which I'm assuming is probably the majority of people that listen to podcasts like this. They're a mechanic, or they work like at Craig and Auto Parts, or they work in a restaurant, and their income creating ability is hindered. They have a ceiling on them. Getting a property that will cash flow is a good deal for them, because you need cash flow to replace the money that you're making at your job. But it's important to note, it's not cash flow in and of itself that is valuable. It's the fact it's buying you freedom. It's getting you back your time, because your time can now be traded for something that makes you more money than you're making at Craig and Auto Parts. That's the first thing people need to understand, is that cash flow is actually a defensive metric. Single family homes are terrible for creating wealth through cash flow. They are not designed for that purpose. They don't work very well. Even when you think you're making good money with those things, man, you get one tenant that trashes your place, and 2 years of cash flow can go away with one turn. And that doesn't get talked about very often. They're not efficient for cash flow. but they're really good for creating equity if you buy them the right way. There's a lot of opportunity for forced equity when you buy single family homes. It's very fast. It's not like an apartment that takes 2 years to turn around that by increasing the NOI. You go in there and buy a fixer upper property, you fix it up, you got instant equity. You buy it in a good neighborhood where things are going higher, a good area. Now you've also got some appreciation there that you can control. You can control appreciation and equity much more than you can control cash flow. So that brings us kind of into step 2. If you're the person who is stuck at your job and you don't have your time back, cash flow can get you out of it. That's not the goal. Now you're free to go like do what you want to do, right? Your wings that were clipped have been freed and you can decide where you want to go in life. And that's really where the game starts. I don't like that people tend to think that's the end goal. I just want to get to $3,000 a month or $4,000 a month and live off my rental income, and I can quit my job and travel the world. Well, what are you going to do if the laws change? What are you going to do if something goes wrong with your house? What are you going to do if you have one bad tenant? It's so many things you can't control when you're living off cash flow. It's a very shaky way to put your life together. I like to say I've got $3,000 to $4,000 going into your emergency account. You got your time back. What job would you rather work? Do you want to work with kids? Have you always had a business idea that you wanted to jump into, but you were afraid? Well, now you've got this nice cushion that you can take risk. And risk is not bad. Risk is really good when you take smart risks, right? You just want to make sure that it can't cripple you. So you hit that phase. Now, some people start at that phase. You might be a person that has a great job already. You're a doctor or you're a dentist. You've got all this extra income. Well, a good deal for you is something that doesn't take your time. It doesn't have to be an incredible return. You don't necessarily have to add a ton of equity. You want to buy really good dirt. You want to buy in the best places. You want to make sure it's not going to hurt you, and you want to wait because you can make really good money at your job still, especially if you love doing it. You don't feel that pain of being in your job. A good deal to you looks a whole lot differently. In fact, if they went after cash flow properties but took a lot of their time, they would lose money to make that $300 a month because they're losing patients that they could have been serving at their job where they would have made more money. And then to go back to the people that we were starting with that don't like their job, once you get that cash flow that buys you your time back, now I really think you want to transition into creating equity. You want to build equity in your portfolio because, again, you can control that. You have much more influence over creating equity, and then trade that equity into cash flow later by a 1031 exchange or some other method like that.
Hold on real quick.
There's a lot there.
There's so much to go over, but I wanted to say you've, in my eyes, you've validated what we're doing. So I really appreciate that, because what we're doing in our business is we're going to buy small multifamily until we can figure out how to buy larger, do the stack. Mm-hmm. And we came across a really good deal in a single family home, and we're looking at the cash flow and we're going, it's really not close to what it is in the multifamily. But if we're buying it $60,000 under market value and putting work into it, okay, this is a different ball game. Okay, so what if it's $300 a month in cash flow? We're going to have instant $80,000 in equity even after we fix it up. So just the mindset of what products or what homes, what investments make you what type of money. It's not all about cash flow. And to go off that point, if you're buying strictly for cash flow, you're probably buying in the worst neighborhoods that you can possibly buy in, right? And then you're really not buying your time back because how many problems go on in those types of neighborhoods?
Yeah, you just buy yourself a job, basically.
Exactly. So go ahead, Ryan.
Mine probably is right off of that. I'm thinking about the same deal we're under contract for, but specifically you touched on forced equity and forced appreciation. Can you dive into that and how you specifically force them in your properties to raise them up? I guess it might depend on market and property type, but just kind of like a little advice there.
Yeah. This is something I learned just from being in the market all the time and noticing that, I'm just glad we get to talk about this because cash flow gets brought up all the time by every guru out there. They're pitching you an easy fix to your problems in life. You don't like your job. You don't like your boss. You don't like your life. Well, buy rental properties and you can be on the yacht with girls in bikinis and in a private jet, right? Like it's just such low hanging fruit that they're going after. And that's why I think cash flow just gets brought up all the time because it exchanges the things you don't like about your life for the things that you do. My advice is, if you don't like your job and you don't like your boss, what about you needs to be changed so you could have a job you like and a boss you like? It's probably not the world's fault that you are where you are, right? And so looking to real estate to be your savior gets people in a lot of trouble. They end up chasing after these worst neighborhoods, and they fall into the temptation of spreadsheet magic and trying to believe that this terrible investment is going to be a good idea because it's going to get them out of their problem. What I've found is that equity, like you guys said, is something I can control a whole lot more. So the first thing that I like for single family homes is, well, let's take a step back. Understanding how a property is valued will let you know what levers to pull on to increase its value. So if you're buying multifamily property, it's valued based on its profitability. You are literally buying a business when you're buying a commercial product. So you can either buy in an area where cap rates are going down. That's a big lever you can pull on. Or you buy a property itself where you can increase the NOI. That's the other way that you add value. And you do that by increasing the cash flow. Well, with single family homes, they're not valued based on the income that they produce. They are valued based on whatever the neighbor paid for theirs. They're literally like, because when you're helping a person buy a home as an agent, they don't care what it's going to cash flow. They're not going to rent it out. What they want to know is, well, what did the Joneses pay across the street? Because I don't want to pay more than them. So we have this whole comparable sales model that determines what a single family home is worth. What that means, if you understand that, is you have a whole lot of control over how you create value in that home. If all the other houses on the street are selling somewhere between 400 and 500, and you go after the nastiest one or the smallest one that has square footage that's not being included in the tax assessor's records, and you can get it for 350 or 320, by making it look like the other ones, which is a fairly simple process. You go on Zillow, you see what they look like, you upgrade yours to look like that or make it as big as that. You made equity right off the bat that isn't going to be taxed. Now, the downside of equity is you can't control when the market drops or something like that. But sure. I mean, right now, with the way inflation is going, even if they drop, it's just going to come charging right back. We're printing money like crazy in the government. But the point is, you want to be involved in what you can control. Okay. So by fixing that house up, you've now made it worth more. And at a certain point, you're going to want to exchange that equity for cash flow. So if you guys do what you're saying, you buy 5 houses the way you're saying, that's $60,000 in each one, 60 to 80, you're going to end up with $300,000 to $400,000 in equity that you can then 1031 into those properties that actually do, where they are made to produce income, a multifamily property. And if you get like a 6% return on that, and you're putting $400,000 of equity, that's $2,000 a month in cash flow that you just created out of 6 houses or 5 houses. How long would it have taken you to save the money to invest $400,000 into that same property?
Yeah. Like mind-bogglingly long, right? Unless you're making your own soap, which neither of us want to do like that. So yes, it's that's very cool. I have a couple questions about your thoughts, since we got a little bit into market trends. Nobody really knows, but you know better than us. So I'm curious, what do you kind of see coming up 2021, 2022? Maybe nothing changes. I'm just curious how you see the outlook of real estate investors, maybe in the 1 to 3 year time frame.
I think people are waiting for a crash. It's not going to come. Again, I don't know that. You're just asking what my opinion is. I don't think it's going to come. And I think it would be good if it did come, to be frank. I think we need a bit of a correction. I would like it if that happened from a selfish perspective, even though I own real estate, because I could buy more of it. I'm not saying this because I don't want to crash. I'm saying based on what we've seen, we just had 2 presidential candidates, a super conservative one and a pretty liberal one. Both of them believed that printing more money was the best thing for the economy. And both of them did that when they were in there. Okay. That's the one thing Americans can agree on, is we don't want to tighten the belt. And that's a pretty concerning problem when you look at like how things really should work in a healthy market. You need to have recessions where it's like a forest fire that clears out all the dead brush. There are certain companies that shouldn't have kept going, that played things wrong or fast and loose, or blockbusters that need to go. And we prevent that from happening. So what I think is we're going to see is, in order for the political parties that be, and this is not me taking a side, it's both of them, to look good, they're going to keep interest rates low. They're going to continue printing money, and they're going to say, hey, look at me, pat myself on the back. Look how good I just did for the economy. It's never been better. Meanwhile, inflation's happening that we're not even paying attention to. So the problem is, if you're not buying real estate right now, you're already losing. Okay. Like, to not take action puts you behind the 8 ball. And people are waiting for prices to drop. I don't think we're going to see that. What I think you're going to see is that inflation's operating at like 6 or 7%, and your property is going up by 3%. and you think you're making money, you think you're doing well, and you're actually losing money because you're not even keeping up with inflation. So I heard someone say the other day that debt is an asset, and that's unfortunately true. I don't think it's healthy for our economy and our country that this is what we've done, but this is what we've done. So in the 1 to 3 year period that you're asking about, I think we're just going to continue to see rising prices. And then in the extra long term, I think that we are going to see a sad wealth gap between haves and have-nots, to where only the people that work in industries that are continuing to see raises, tech, biotech, medical industry, areas that are benefiting from all this inflation.
Digital space, really.
There you go. They'll be homeowners. Okay. But if you're just the person that is like, you work in the bread factory, or you're a teacher or something like that, you just aren't going to be able to buy a house. They're just going to become too expensive. And I don't think that that's good. This is not me as the greedy landlord saying, ha, ha, ha. Right. I think that there's nothing I'm going to do to stop that. That wave is coming. And I want to position myself in a position to catch the wave and tell as many other people as I can, this is where I think you should be when that wave hits, because you want to ride it. You don't want it crashing on your head.
Not to say, just like you said, not to say that you are saying this is a good thing, but it's, you either are on one side or you're on the other side, right?
For the record, I think it's a bad thing. Right. I think we need to interest rates need to come up. Inflation needs to go away. We need to let some of these companies that shouldn't have been in business go out of business. I think there's a price that we should all have to pay for shutting down the entire country for a while. That's natural. I'm not saying that I'm angry about it, but when you shut things down and people don't go to work and they don't produce, there should be a natural consequence, right? I look at it like a sleep cycle. Okay. Human beings are awake for 16 hours and they need to sleep for 8. They're awake for 16. They need to sleep for 8. We hit the point where we should have went to sleep. And instead of letting the country sleep and wake back up and start again, they just shot it full of drugs. And we're wild, right? So people keep pointing out, look at our energy levels. Look how great it's going, right? Like, we're charging forward. There's no recession in sight. And we're not considering the fact that shooting yourself full of drugs and never going to sleep will lead to serious health problems and like a complete crash.
Interesting.
You definitely just watched Crank last night. He's all two of the same analogies. It's amazing. That's awesome. A lot to think about here. So specifically, I heard you speak on this before, like think in decades, right? And I agree with you. Like something has to give a little bit here, but I do feel as if it's going to be either you're in or you're out, or you're kind of going to miss the wave, as you mentioned. And so how do you feel about now? Like, when interest rates are as low as they are, do you feel as if people should just be taking advantage of essentially the free money that's out there? Because if the wave does come up and they shoot up to 7, is it going to be, they might be not able to get in at all?
Yeah, I would say when it comes to that advice, the answer is if you are financially stable and you care about wealth building, you should be buying some form of a hard asset. I think we've injected a ton of stimulus into the country and you don't know where it's going to show itself. It pops up in weird ways. Like if you guys have you been following cryptocurrencies and seeing what they're doing right now?
Yeah. Not in it, but yeah.
But you're watching it, right? That's a big reason people are doing that is because they don't trust the dollar. Smart people are like, I don't know what's going on with that. I feel better here. If you're looking at the price of baseball cards or basketball cards, it's kind of weird how inflated those type of assets are. They shoot this stimulus in and it bubbles up in weird ways that you can't really predict. I want to own hard assets because it's some form of reliability. The odds of someone needing a place to live, that's one of the last things you're going to lose. So if you can buy real estate and it's not going to put you in a position of financial risk, that's what I wanted to highlight. This isn't 2005 where you're buying because you just are betting it's going to keep going up and you're just going to sell it. Don't take out a loan you can't pay. If you're already in debt, don't take on more debt with an asset you don't know how to manage, like real estate. But if you're in a relatively stable position, you kind of have to do something right now. You have to acknowledge that this inflation isn't likely to stop. They've already said they're going to print more of it. And if you're now the politician who steps in and says, all right, I'm putting an end to this. We're cutting spending. We're getting rid of programs.
Voted in. That's the problem.
Exactly right. You're not going to get voted in. That's exactly where I'm getting at. So
it's the worst position. It's really a tough place to be in. It really is.
Someone's gonna have to pay for all this. I mean, my brain is going in so many different directions here. I heard you talk cryptocurrency, baseball cards. I'm thinking NFTs, I believe they're called now. Like these, like I guess you buy a piece of a moment, like a virtual moment. I'm like, I don't know where the world's going, and it just bubbles, like he said. It's just pushing things to rise, and that it should taper out again. And I do feel real estate will stay constant. by thinking in decades, right? You get in now. I believe you said this before. It was like a person will never regret 30 years down the line the property that they did buy, but rather the property that they did not buy. And you can't go back 30 years. I think you said inflation will take care of itself. But at that time,
have you ever met a human being in your life that bought a house 30 years ago that said, I wish I wouldn't have bought it?
Never.
Like they all say the same thing. What's the same thing every one of them
I wish I would have bought more.
That's exactly right. 100% of the people I've ever met, that's what they've said. And I think we're going to have more inflation over the next 30 years than what we had over the last 30 years.
Yep. Incredible.
One more on this is like, I've also heard people say, well, what if, I'm renting this out. What if the rents go down? When is the last time I've ever heard any human being tell me that their rent decreased?
Maybe 08. Did it even in 08?
No, it didn't. Because what happened is everyone lost their houses in 08 and they needed a place to live. So if you were a landlord that had a house you didn't lose, there was massive demand. Everyone was fighting to get in your house. Rents went up then too. The only thing I can think of that would make rents go down would be if you were in Detroit at that period of time, your rents went down. Okay. If the area that you're in loses demand, nobody wants to live there.
If the jobs leave.
Yes, the jobs leave. Or if somebody designs like a 3D printed house and they build a bunch of houses in the desert or something that everyone goes to live in, it would take something like that to literally you have to lose demand for rental property. Maybe if human beings stopped having babies and the population just dwindled, we didn't need all these houses. But outside of something like that, rents just keep going up.
Can you diminish some fear for people too here with 08 again? It's like a lot of people say, oh, real estate went down and it crashed and the bubble exploded and it was all real estate in 2008. When in reality, was it not the financial market and over lending essentially to people that couldn't afford it, that should have been renters anyways?
That's what the wise people understand, that we didn't have a housing crisis back then. Yeah. Great job there, Ryan. Wise Ryan. We didn't have a housing crisis. We had a credit crisis. We were giving loans we shouldn't have gotten. And for people that don't understand real estate, they don't get that the value of the asset is tied to supply and demand. That's pretty obvious. But prices can only go as high as someone's going to be willing to lend you money to borrow. So when they were tweaking debt to income ratios and using adjustable rate mortgages, they could justify lending you money that they won't do right now. So even though people are complaining all the time that houses are expensive at this point, the fact is that's because people are making more money. It's because of inflation. They wouldn't be able to buy them if they couldn't afford them. The debt to income ratios are the same. And I've yet to see the human being that says, I'm getting so many raises at work. This is ridiculous. This is unsustainable. We need a crash and I need to get paid way less from my boss because this just can't go on.
This brings me, that's really funny. This brings me to your kind of got on the topic, your mortgage team and your mortgage company that you started, along with your real estate team. So if you could dive into maybe both of these and how you parlayed your real estate investing into your mortgage company and your real estate team and how they kind of all go in this cycle.
Yeah. So I'm really big into the concept of synergy. I'm a Golden State Warriors fan. They're not so great right now, but if you follow the Warriors 5 years ago,
every Golden State Warriors fan became a Golden State Warriors fan about 5 years ago. So how long have you been?
Yeah, maybe 8 years. I was a Kings fan before that. They had synergy.
Okay.
I like the Warriors when the Warriors developed synergy, right? Yeah. What you had was the pieces of the team that they brought together not only were good, but they made the other pieces better. Okay. If you took Draymond Green, who's a great defensive player, and you stuck him on another team, he's way less valuable. Okay.
100%.
He's only great on that team. No, not at all. But when he plays with Steph Curry and Klay Thompson and all the all-stars that they have around him, he's providing what they aren't. Okay. They don't need more firepower on that team. They need that. Same with Klay Thompson. Great player. Wouldn't be one of the best shooting guards in the NBA if he wasn't playing with Steph Curry. He gets by with the skills he has because Steph Curry draws so much attention. And Steph Curry has like pretty much two weaknesses in the entire game. He's not that big, so he's not a great defender, and he turns the ball over more often than most people would in a position. Well, he can get by without being a great defender because Klay Thompson is a great defender and is big, right? It's like a perfect match of each of them bringing out the best of each other. My mind has always looked to that. I think it's because I had a background in basketball and I understood how team sports worked.
I knew I liked you.
Thank you. Basketball fan too.
Tell him you're a coach.
Yeah. High school coach, but go ahead.
Right on, man. That's awesome.
Yeah.
So my real estate investing gave me a knowledge base about how real estate worked, what a deal looked like, how all the pieces kind of fit together, and really how to understand it from a background of how it makes sense financially. When I got my license, I started competing with all the other realtors. who knew none of that, who only understood the emotional side of, don't you think the kitchen's really cute? Can't you see your kids in this yard? They didn't have the knowledge I did. So my whole database sort of knew me as a real estate guy, which means when I got my license, they're coming to me with leads a whole lot easier than somebody who's starting from scratch. So I sort of picked up momentum relatively quickly. Then I got confidence, and then confidence made it a whole lot easier to keep learning. I got lucky also in the sense that I did not really like the job. That's something I don't talk about a whole time, but I was not made to be a real estate agent. So because I didn't enjoy what I was doing, I quickly moved out of I want to do it and into I want to hire someone to replace me to do these parts of the job on my team, which I already understood how to do because that's what I did with investing. I had my core four. I had a team of people. I knew how do I chunk this part off and delegate it to somebody else and make sure they're a good person. Well, I naturally started doing that in my agent business. And then as I did that more, I could spend more time generating leads, which meant I had more coming in, which meant I could hire more people, and synergy started to take effect. And I started to get this momentum like we were talking about. Well, at a certain point, I get on the podcast and now I'm talking about real estate and I know more about it because I've been selling it and because I've been buying it. Well, the podcast gets me more attention. Now, even more people are coming to me that want to buy houses. There's more momentum. I get these book deals. The books sell really well. That's more people that are coming to my business. Now I'm helping more clients with house hacking and with investing. I'm learning even more than when it was me. I have more information to put into more books. And then that's like rocking and rolling. In 2020, I sold 146 houses, and that's in one of the a really expensive market. The Bay Area is tough to even sell 5 to 10. So I start this mortgage company, which takes off really quickly because I've got a ton of leads coming into it. And I already understand how to chunk up the pieces of being a loan officer, assign them to the right person, and do the same thing with that I did with the real estate team. And so I guess the point I'm trying to convey here is if you want to get out of the situation that you're in, a lot of people make the mistake of starting over completely at a brand new thing and have zero momentum. They're trying to get that bike moving again. What I did is I looked at what do I have right now? What would fit really well? Okay. Like Draymond Green, nobody wants him. He's a second round pick. He got skipped by everybody else. But for the situation I'm in, yeah, right. The situation I'm in, that Draymond Green is very valuable to me. I want to go after that person. And so now I can hire people that wouldn't make it on their own. They would never make it as an agent because they don't want to generate leads. They don't want to talk to people, but they're incredible at showing houses. And luckily I got enough people that need to see houses that's all they got to do. Now I have this awesome showing assistant that makes everybody feel like gold. She wouldn't have had a job if it wasn't for me. And I get by not having to pay an agent as much money because I have this person that's just my showing assistant. It works for everyone. And that's really what I want to highlight is when you're stuck, look for ways that you can use synergy and momentum to push yourself forward without just starting from scratch.
Wonderful. So if you're looking for a home or a mortgage and you're in the Bay Area, you know who to call. It's really that simple. I mean, he just laid it all out there for you. So
yeah. Well, specifically, how would someone get in touch with you if they did want to take advantage of your services?
Thank you for that. Yeah, we're licensed all throughout California. So if you hit me up on anywhere on social media, I'm David Greene 24, or you can go to davidgreene24.com and there's a connect button. If you just put that, it'll put you right into our CRM and somebody will be reaching out to you guys, to them right away. And thank you guys for mentioning that.
Absolutely. Awesome. Happy to do it.
Yeah. So we want to dive into BP in your books a little bit before the last segment of our show. So, I don't know how many times you've been asked this. I'm curious how you got connected with BP in the beginning and then parlaying that into, it's one thing to be a real estate investor and invest long distance and invest in the burst strategy, but like to write books on it, you have to be an expert, right? And you also got some criticism for like long distance real estate investing. So I want you to, that was a lot there. I just threw a lot at you, but if you just talk about the inception of you getting involved in BP and then how you started writing these, wonderful books.
I think because I could tie all that together with the answer. It's a very good question. And it's an awesome way to highlight everything I just ranted about for the last 10 minutes as far as momentum. Like I can give you a case study in how this should work because it happened with BP. This is where I first realized, oh, that's what I'm doing. It made sense to me. So I'm in a group called GoBundance, and Hal Elrod, the author of The Miracle Morning, he's in GoBundance. You guys just made a face like you know.
Dude, I'm sorry not to dive in there, but Tribe of Millionaires is one of my favorite books of all time. Read it 3 times already. Diego Corzo, he's been on the show. He was featured in the back. I will be in that group one day. I swear to God. But it's amazing that you're in there. That gets me jacked. I'm like so excited that just Go give it to them. Tell them what they need.
All right, cool. Anybody that wants to be in GoBundance, just tell them David Greene sent you. You can get to the front of the line. So I'm talking to Hal Elrod, and he had just been on the Bigger Pockets podcast. And my buddy Andrew Cushman and I were thinking, like, wouldn't it be cool if we got on the podcast somehow? I never thought that I even had a chance. So we go chase down Hal, and we're like, hey, do you think you could introduce us to the Bigger Pockets guys? And he goes, sure. He sends an email to Brandon and Josh right then and there. He includes us. They reply back and they're like, yeah, talk to this girl. Her name was Hillary. She's the one that picks the guests. So I email Hillary and I was telling her my story. Hey, I'm a police officer. I saved up money. I bought these houses, and she loved it. Next thing I know, she scheduled me for like 4 days later. I've never done a podcast. I've never talked about real estate to a group of people. That's my first one as I'm walking into like the big show. Right. So I look up online how to be good on a podcast. Yes. I didn't know what you're supposed to do. Right. I knew this was a big deal. I called a couple people to ask them what to do. I sit down to do the interview. I catch a rhythm when I'm in it. Thank God. It wasn't really that awkward. And because I listened to so many of their podcasts, it was like we had a rapport. I knew their inside jokes. I knew that Josh likes to tease Brandon. I kind of jumped in on Brandon with Josh. It went really well. And Brandon said, hey, that's one of the best shows that we ever did. You know, you were really good at this. And I said, thanks, man. Can I get your phone number? And of course he gave it to me because Brandon doesn't like to say. That's a little quick tip for everybody.
He doesn't like to say no,
Brandon,
right?
He'll probably give it to you. Yeah.
That's great.
And I said, hey, I want to write for the blog. And he said, oh, that's no problem. Let me connect you with the blog girl. So they connect me with the person that was running the blog. And I just said, hey, I want to write articles. She said, give me a sample. I wrote one up. I had like 4 people look at it and edit it to make it look as good as it could. I gave it to her. She said, I love this. Change your tone a little bit with the way you're talking, and I'm going to make it the editor's choice. My first one ever. So now I went to her and I started to say, give me a list of every blog article that's the top on the site so I can mimic that and do this. And tell me what else you want. What can I do to make your job easier? And she had been used to everyone like, hey, can you put my blog at the top? How come he got it and I didn't get it? Like that, the babysitting stuff. And I'm coming to her saying, how do I make your job better? So I start writing blog articles for them, and she loves it. And she really likes me. That was like, I've now taken the podcast. I've turned it into a friendship with Brandon. I've turned it into knowing the blog editor. And they had a meeting and they decided, unbeknownst to me, they wanted to get other authors other than Brandon and Josh writing books. And they said, hey, they went to her and said, who is your top writers? And she said, well, David Greene's the one everyone likes the most. His blogs do the best. So they approached me and I pitched long distance investing, and they said, sounds great. That turns into a book. The book ended up doing pretty good. And I think I handled the criticism of it pretty well. That was actually a blessing because I didn't get defensive when people would say, that's so risky. How could you tell people to do it? I had a really measured, articulate response that nobody could really combat, and it made BP look good. So because that book sold well, I got to go back on the podcast to talk about like hyping it. So now I've done 2 podcasts, and I go on this tour of podcasts to hype the book because I really want it to sell really good. Well, I get good at talking, frankly. All these podcasts, you start to articulate things a little bit better, be a little bit more entertaining, a little bit less of a cop. And then I get another opportunity to write the Burr book, and I jump on that and I do another BP thing. I've been on there 3 times now, another round of podcasts. It went super good. Now I'm like a staple. I've been on the podcast several times. I've written a couple of their books. I'm still writing blog articles. Me and Brandon have become friends. And I just waited. And when Josh stepped away from the podcast, there was sort of a vacuum. They didn't have a person that could step in and really take over for Josh. They plugged a few people in. They didn't have good rapport with Brandon, or they didn't have much experience with investing. And because Brandon and I had become friends, he was really an advocate that said, hey, we should bring David in. We should let him do this. And I did a couple guest spots. People really liked it. And the next thing I know, I'm sitting as the co-host of the biggest real estate podcast in the world. And I really can't take a ton of credit for it. I think God opened a lot of doors when it comes to that. But what I did do well was I continually capitalized on every opportunity they gave me, did as good as I could, and saw what door it opened next. And that's really similar to what I was saying about the synergy. There's things in your life right now that people have that they're just not paying attention to. They're looking for an opportunity to come in a way that it's not going to come, or they're not making the most of what they have. They're saying, when I get my opportunity to shine, then I'm going to do my best. Okay. You're on the single A ball club and you're like, hey, when they call me up to the big leagues, I'll start doing batting practice every day. People don't realize it, but that's the subconscious mindset that they're taking into work every single day. If you started to say, I'm going to train like they're calling me for the big leagues tomorrow, I'm taking batting practice every day, I'm going to crush it with what I have. The coach is going to see me out there working. He's not going to be able to ignore how hard I'm trying. My boss is going to love me. you'll find that when they need somebody, you're the one they come tap on the shoulder of. And that's just one of the philosophies I've taken out in life is quit waiting for other people to do something first. Quit saying I'll love my boyfriend or girlfriend when they love me back. I'll be good to them when they're good to me. I'll try really hard when they give me a raise. Empower yourself by starting with that, and you'll find that those things come your way.
Incredible. Super. I mean, like, what else do you say? I was just going to rattle off a bunch of adjectives that were incredible, but I think one of the points I took from that is that the providing the value in the beginning had set the stage for you to bob and weave and figure out where you fit in. And that is huge, because a lot of these people who were writing the blog were asking, what can you do for me? As opposed to you saying, how did I make this Hillary, right? That was her name. Or it was, yep. Yeah. How do you make her life easier? And it worked out. And all of a sudden it comes full circle. It's like, that's pretty special, right?
It's incredible. And like, I think a lot of people always ask like, okay, I have a goal. I want to be a millionaire. I want to be a movie star. I want to be in movies. But like, they assume exactly what you said. Like at one point, someone's going to come save them, and you're going to plant you in this role where I think I might've seen like a meme about this the other day, but like specifically it's like, what is the secret sauce to success? And it was I think a SpongeBob opening up his golden spatula and it said hard work and consistency plus dedication. Just like literally taking action and doing it yourself. And I joked earlier and I called you a control freak. Sorry about that. But like, that's to me to a T. I freak out if someone does something that is not perfect or efficient or has synergy in my head. And I'm like, what are you doing? And it might be to a fault that I just have to take the whole project and do it myself. And it's, building systems and getting better along the way. But I really appreciate that mantra and where you come from, because it proves that people that do this over a long period of time will see great success. And for that, I thank you very much.
I would add, and I don't want this to come across wrong, so anyone who hears this, if it sounds like it came across wrong, just give me the benefit of the doubt. It's not an insult. One of my favorite things about America is that not many people are really trying their hardest to get ahead. It's remarkably easy compared to other parts of the world in America, with just the fact we're printing money this much to be successful. And you often see people that come to this country from other countries that bring a completely different work ethic. Because in that environment, it was incredibly hard to get ahead. They did not have opportunity. Maybe they couldn't even be a homeowner or something like that. And they come here and they're like, you're kidding me. Your country gives you a 30-year fixed rate loan and they're keeping interest rates as low as they possibly can. And they're going to sponsor your loan so you can put 3.5% down instead of 50%, which I had to do in Egypt or something like that. Yeah. And they just dominate, right? Because their mindset when they come here is one of, I expect hard work and dedication plus commitment and consistency to be what I would do. And so I don't like to look at those people and be like, oh, they're taking American jobs. I like to look at that and be like, that's what you want to copy, right? Like I tend to look at the world from a capitalistic perspective. Like you want to make the pro roster, you're competing every day for a spot on that team. And if they can go get a person from Europe to come in and replace you, that's what they're going to do. So don't be mad at them bringing players in from other parts of the country. Step your game up so that you outperform those people that would come. And I think that's just like a healthy attitude to take when you're serving your job or you're serving your family, you're trying to be the best father, brother, whatever it is in your life.
Great. It's really well said. I think the second to last segment, close to the last segment of the show, is called the Core Four. So we're going to go into like 4 questions, similar to BP, where you kind of ask the same questions all the guests. One of them is one of the same questions you guys asked. So the question 1 is, what is your favorite investing or business book? You can say your own. I'm cool with that. But what do you, maybe for people who just get started or just, yeah.
It's The Richest Man in Babylon. I love that book. It's somewhat simple and it's an easy read. If you don't like reading, you won't have a problem reading this book at all. But the principles in it are powerful. I continually look back when I'm faced with decisions. What am I going to do? And it often comes down to what would the richest man in Babylon say?
I love that book.
I'm just very excited that you mentioned that, because we just hit our year mark, and our very first episode, Cory asked me what my favorite book was that I would recommend, and it was The Richest Man in Babylon.
Nice.
And that's just perfect to a T. Destiny hit perfect on that one, so thank you for that. I love the book. It's an easy read. It's parable, you know what I mean, and it totally applies to today. So thank you. Second one of the Core Four, What's been your biggest mistake throughout your investing journey? And what have you done to essentially capitalize on that mistake and learn from it?
My biggest mistake was that around 2016, 2017, I fell prey to a phishing scam where my assistant had entered my bank account information into an email that was sent that wasn't from my bank. And people tried to steal every dollar that was in like 5 different accounts. And I got lucky that the bank recognized it and shut it down. But I got unlucky in the sense that I had to shut down all 5 of those bank accounts and set up new ones. And at the time I had somewhere around 25 to 30 rental properties and had no idea like what was all being electronically deducted from what. I was very unorganized. I had wires crossed. That was at the same time that my agent business was first starting to take off. I was getting very busy. I was trying to hire new people. And I had to make the decision of, well, do I let the agent business suffer so I can go clean up this mess? Or do I let the mess work itself out while I keep my foot on the gas? And I still, with hindsight, think I made the right decision, which was to keep my foot on the gas.